This is your LMAX Exchange technical update for Wednesday, May 10th, 2017. Euro dollar. So the euro has seen some setbacks in recent trade, though these setbacks shouldn't be viewed as a resumption of a broader downtrend and merely a minor correction within what is seen as a more constructive outlook for this market. While we could see pullbacks extend some more back down towards filling that gap that we'd seen several days back towards 107.30, there is risk for another higher low above the previous higher low at 105.70 in favor of that next major upside extension back above the recent highs just over 110 and towards a measured move target at 114 further up. At this point, only a break back below 105.70 would compromise the newly adopted constructive outlook for the euro. But again, there is still risk that we see additional setbacks towards the 107.30 area before the market considers a resumption of recent gains. Sterling dollar. So cable continues to consolidate above the previous breakout point, that resistance point from 127.75 that had so well defined the top of a range for several months since bottoming out by plus 30-year lows at 118.40 back in October of 2016. The breakout signifies a shift in the structure and now suggests that the market could be poised for fresh upside over the coming days towards a measured move extension at 135. At the same time, there are still risks for short-term setbacks, but these setbacks should now be supported in the 125 area with only a breakback below 23.60 to compromise the newly adopted bullish outlook for the pound. Dollar yen. So dollar yen has extended its run of gain since bottoming out at 108.13 in 2017 back in mid-April, and this run now could be looking to retest some key resistance at 115.60 further up, which had been a previous range resistance before the market broke down in March. But while the market holds below 115.60, there really is no bias either way. The break back above 12.20 takes the pressure off the downside, but while below 115.60, there's no reason to be getting too bullish on dollar yen. So the market is right now in a bit of a neutral zone with 115.60 above and 112.09, a recent low, below as the key levels to watch. Euro Swiss. So Euro Swiss has been on a tear over the past several days, with the market now trading up towards a major psychological barrier at 110, which happens to coincide with some key resistance from September of 2016. It looks like it might be tough for the market to break above or establish above 110 over the coming sessions, but there is signs now that we are seeing maybe a shift in the structure, which could focus on more significant upside over the coming weeks and months. If the market, though, is unable to sustain above 110, we could just as easily see another topside failure, with the market rolling over back towards some recent multi-day range lows down towards the 106 area. Aussie dollar. So Aussie is showing signs of topping out, with the market extending setbacks in recent trade as soon as recent as yesterday, down to lows at around 73.30 ahead of this latest minor bounce. But any rallies that we do see should now be well capped into some previous support term resistance in the 75 area, with only a break back above 76.11, that high that we saw back on the 17th of April, to compromise the bearish outlook. At this point, the focus now is on retesting some lows that we had seen back in December of 2016 at 71.60. Dollar CAD. So dollar CAD has been very bullish as far as price action has been over the past several months, and then we've seen this acceleration of gains in recent days up towards fresh 2017 highs, just shy of 138. The market has seen a bit of a corrective period over the past few sessions, which is understandable given the intense moves, and this correction could very well extend back down towards the 135 area. But ultimately, while the market holds above a previous higher low in the 132s, there should be another higher low forming in favor of a continuation of gains back above the 2017 high and towards the next target area, which comes in by psychological barrier at 140. Again, ultimately only back below that recent support around 132.20. That's the low that, going back to the April 13th, would compromise the constructive outlook. So if we do see setbacks over the coming sessions, they're only classified as corrective and should find some support in favor of a continuation of gains. Kiwi dollar. So the New Zealand dollar has been consolidating in recent trade, but overall, this is a market that is showing signs of topping out and warning of deeper setbacks. A breakdown below the recent 2017 low at 68.39 would expose the next major downside extension towards psychological barriers at 65. At this point, any rally should be well capped, with only a break back above 70.90, that high going back to the 21st of March, to compromise the bearish outlook for Kiwi dollar. SPX 500. The S&P 500 has recently put in a fresh record high above 2400, and this sets the stage for a potential upside towards 2480 in the days ahead. Remember, the market had previously topped out by a record high at 2400, right? That was set in early March before pulling back down to 2320 and then rallying back up. So the move that we saw from 2400 to 2320 was an 80-point move, and so the break above 2400 recently projects 80 points potentially to the top side, which takes us up to 2480. It would take a break back below this critical support going back to that low from March at 2320 to really force a shift in the structure and take the pressure off the top side. Gold. So gold has seen some intense setbacks over the past several sessions, but if we look at the price action since basing out in 2016, the market is still showing these signs of higher lows and higher highs and a more constructive outlook, with the potential for gains to continue extending towards a next key measure move at 1335, which is just shy of the 2016 peak at 1375. And so despite this latest pullback, the market could still be thinking for another higher low in this area here in favor of a resumption of gains. Only back below 1195 would really threaten or compromise this outlook, while a break below 1180 would negate any constructive outlook and put the pressure back on the downside for a retest of those 2016 lows. But again, the key takeaway here right now is that despite these latest setbacks, the market could once again be looking to put in a higher low in favor of additional upside back through 1335.